It is an honor to be here. My name is Giulia Carbone. I work for the World Business Council for Sustainable Development, where I'm the director of the Natural Climate Solution Alliance and the Forest Investor Club. So actually, even before I spoke to you and said, why am I here? I was trying to figure out why Warren asked me to facilitate this panel. And I think it's because the convergence between demand for natural climate solutions or nature-based solutions that actually contribute to mitigate climate change, and the Forest Investor Club that brings together a group of investors dedicated to natural climate solutions, so to push the topic of natural climate solution investments. Definitely I'm not an expert in DFIs, but this is why we have three panelists who will give us some ideas of how they operate. But before that, I just wanted to remind us why we are talking about these issues. And I think definitely this morning we have heard a lot about the importance of nature as a solution to climate. So I will not repeat that. Just the one number that I really like, which is a very simple number, is that nature is 1/3 of the climate change solution. So we can't get to net zero without nature. So that I think has to be part of everybody, every stakeholder group understanding of if we want climate change, we also have to have nature. And this is where we bring them together into this definition of natural climate solutions, which are really about the protection of nature, improved management and restoration with benefits for climate, biodiversity and people. So also in business term, it's really a good way to spend money because you get actually multiple benefits, right? And we are not talking about co-benefits because they are equally important. The other really important point is that the nature, so nature protection, improved management and restoration is massively underfinanced. I'm just going to quote some stats from the UNEP State of Finance for Nature report that was issued at the end of 2023. The current finance flows to nature-based solutions is around 200 billion, which is 1/3 of the levels needed to reach climate, biodiversity, and land degradation targets by 2030. 1/3. The majority of this comes from government. The 18% come from private finance. So it's really small, and we need to basically, triple that for 2030 and more. Another interesting stat of that is that actually the private finance flows that goes to NBS today is less than 1% of private finance flows that have a direct harmful impact on nature, which it's a different discussion which we are not going to have with you now, but it's a really important point to keep in mind. Like there's so much negative finance flow which needs to be redirected, and we also have to generate more finance going to positive business models, and this is why we're here. So in this context, really the question is, what is the role of DFIs? And before we go into the detail of the questions, I just actually, even for my own understanding, what does the D mean in the DFI, right? So why do we add the D? So I'll start with you, Tobias, and then we have, if you maybe just state your name and your organization before you start the first intervention.
Thank you, Julia. Thank you, and hello everybody. I'm Tobias Dorenkamp, and I work in the Global Climate Investment team of DEG, the German Development Bank, and we are tasked to build up a portfolio of nature-based solutions projects and a portfolio of that in the coming years to reach net zero by 2040 for DEG and its attributable emissions from its portfolio companies. To your question, the D, indeed, very literally answering it, is standing for development, so development finance institutions, well, that is our term. In practical terms, that means for the last 60 plus years, our mandate has been to invest only in emerging markets, developing in emerging markets, and to finance private enterprises there. And I think that's important and a differentiating factor to other financial institutions who can move out or in as depending on financial crisis and others. We are there to stay and to provide long-term capital to foster economic growth, but also to create formal jobs, to install high environmental social governance, and also in the contract, or in our example here of forestry, plantations, FSC certifications, other standards which are important to higher or elevate the level of ambition of these projects. Thank you.
Right, Peter, to you, the D.
Hi, yeah, my name is Peter Chappell. I'm here representing FinFund, and FinFund being the Finnish government's equivalent of DEG. We have 4 sectors in that we invest in. Forestry and agriculture is one of those 4, so it represents about a quarter of our portfolio, which is in total about €1 billion assets under management. And of that, forestry is about 160, 170 million at the moment. And same as Tobias said, all in emerging markets. We have very high exposure in Africa, and also to some extent in Latin America, and also in Southeast Asia. And for us, the D, I mean, thinking more specifically really about the kind of forestry and ag context of this, I think it's really about thinking about what's the impact, because this is often in very rural places in these emerging countries. There's probably not a lot of formal employment opportunities, and sometimes our investments can be really catalytic to actually create jobs, and then that also provides the companies that we invest in a vehicle to be, as mentioned, the standards. We can try and look to improve gender balance. We can try and progress all kinds of different agendas. And really the objective is to try and move perhaps people in some of those locations away from potentially unsustainable livelihoods, maybe which are linked to things like deforestation, and get them into sustainable employment and also sustainable land management.
Thank you. So, Jean-Gabriel.
Thank you. Jean-Gabriel Der, I work and represent Proparco today. I'm part of the newly created team, a natural capital team at Proparco. To answer your question, Julia, what do you mean by development at Proparco? I think what we are very much aligned indeed with my 2 fellow panelists, in the sense that institutions, in the sense that we at Proparco intend to have a positive impact on sustainable development goals. What differentiates probably Proparco from DG and FinFund to some respect is that we have a clear focus on Africa. 50% of what we do on a yearly basis is invested on that continent. And we have also a very strong climate mandate. So overall, Proparco is an institution that is owned majoritarily by the French government, but also with French financial institutions. And we invest some 2 billion euros a year, 50% of which in Africa.
Right, thank you. So what is interesting is that we are in a panel that we are talking about nature-based solutions or natural climate solution, combining nature and climate. And the D comes very strongly across as a social aspect, right? Development and jobs and so on. So could you explain how nature actually has a key role, because you're here, so I assume it does, in your strategies, and how do you connect nature to development? And yeah, so I'm asking the same questions to all of you, because I think it's interesting to see the similarities or maybe differences and specificities. So again, I'll start with you.
Thank you. I think you touch upon a very important aspect. So the development was often and for many decades interpreted more on a social part. Climate played a role, but not the significant role. And I think we can also see that, frankly, DG's portfolio for roughly 10 billion euros. The sustainable agriculture and forestry part of that portfolio is 200+ million, which sounds good, but in a 10 million portfolio, it's not that big, right? I mean, there are many indirect. We have a lot of refinancing of financial institutions and other which are active there, but in principle, the direct portfolio is relatively small because it hasn't been the full focus it deserved. And I think that is more recent development, we focus more on the climate aspects, and we build up with strategies the portfolio. Where does it come from? Obviously, it's the risk-return perspective is much more challenging in climate projects and nature-based solution projects. And there is sometimes often a trade-off as well, no? Between social aspects or economic aspects. And although we need to remain as well on a different to on a profitable basis. So DG is a limited liability company. Overall, the projects need to generate at least some return, and therefore we need to also balance how much we can do in which area.
Yeah, we are gonna talk about that. You know, the difference between a DFI and a normal FI in terms of, and I assume the returns that expected will play a big role. But let's continue about, you know, how do you see the nature? How do you position nature now in your portfolio? That starts with a D, but
Yeah, right. And I think for us, when we're looking at a particular project or a company, prospective investee, of course, there's the social aspects and there's the nature aspects, there's the climate aspects, there's all these different aspects. But actually, all of them are inextricably linked together because they all flow back to the ongoing successful execution of whatever that business's plan development is. And that's the vision that we have, you know, with our prospective investee company. So in a way, it's difficult to kind of pigeonhole these and say, okay, we want to achieve this particular impact, because we're only going to get that as a package with all of these other impacts, which is completely unique on a case-by-case basis. That said, of course, what's absolutely crucial and is that it's financially sustainable, as Tobias kind of hinted at there, because ultimately, there's no point us coming in as DFIs, achieving some impacts for a few years, but then actually the business isn't financially sustainable, because then all of those impacts are not secured over the longer term. So the underlying cornerstone is absolutely the financial sustainability. And if we can get that, then all of the other co-benefits will flow from it over the longer term.
yeah. So I understand that you're saying they're integrated and you will, but I think what is important is, I guess, in the design phase already, you're looking for these additional elements, right?
Yeah, although, like we just said in the chat just now, I mean, sometimes proposals, I think, can be too impact-led, because actually it's not respecting this cornerstone. If we get the cornerstone, you know, the impacts are available, as you highlighted in introduction. There's enormous impact possibilities from all kinds of different angles. And so, but we've got to get the cornerstone for these impacts to actually be implemented. And sometimes we don't even want to push those companies too hard to be too impactful, which sounds a bit counterintuitive. But if our financing is very additional, you know, we may have a lot of leverage with those companies, and we could perhaps insist on huge, you know, agendas, nature restoration and social enterprise and so on. But again, if that takes the company away from being competitive within the local context, then actually it's not going to be secured longer term. So we want to make sure we're moving the needle and that we are achieving a change from the status quo, but it's got to be financially sustainable.
Over to you.
Here I'll try to bring something in addition to what my colleagues have already said about the necessity of indeed financing sustainable business, including financially sustainable businesses. You ask about how nature is related to the social ambitions that is at the core, as the raison d'être of DFIs. I think in the introduction you also mentioned that nature is part of the solution to the climate crisis and climate change. And I think that's very much what ProParco is now also taking action on for quite some time, probably for more than a decade now. We have had a climate strategy at ProParco. We've been trying to develop and foster a number of pro-climate initiatives through financial institutions, through renewable energy projects. Now we do also realize that a number of projects that we did finance in the past in the forestry sector, in agriculture, do have an impact co-benefit that we need to act on. Therefore, we created, as I said recently, some 2 months ago, after efforts in terms of landscaping, origination, and a very long thought process about risk assessments and risk appetite, a natural capital team. The way we are going to go about it is that we will try to finance new projects in 3 verticals when you speak about nature. First, it's be the 3 natural capital assets: forests, agriculture, and even ocean-linked projects. I think this year we will very much focus on forest and carbon projects, as well as regenerative agriculture. Because again, as you said, nature and soil is certainly a carbon sink that we want to leverage on by funding, investing in companies and projects that develop regenerative agriculture projects. I mean, agriculture projects that have the capability of sequestering, capturing carbon as well.
So this is a great segue to the next question, which is basically what, we are talking about investment and so on, but can we be more precise about what are the asset classes that you invest on? So you already said regenerative agriculture, carbon. I'll go first to Tobias.
Right. I think there are many ways how to cut and slice it, no? But how we like to look at it is basically to differentiate in 2 asset classes. One is, and we are still looking for a better term. So in lack of a better term, right now we just within ourselves, within the bank, we say sustainable solid product asset class. So sustainable solid product in differentiation to carbon credit projects. So basically you have with regenerative agriculture or with forestry plantations or timber production, you have solid products which you sell on the market. You work in the normal business world on selling your product, and you have an additional product which is a carbon credit, and which is this additional revenue stream. But your main revenue and your main risk return really comes from that produce. And then we see the carbon credit projects, which mainly or most of the time entirely depend on carbon credits as a revenue stream. And with these 2 asset classes, we like it to slice it that way, come very different challenges, very different investors. So on the first, you see institutional investors, you see pension funds, you see others. On the second, you hardly see them. You see corporates who want to become net zero. So very different types of investors. You have very different markets, obviously. To sell your timber to international markets or to the next sawmill is very different to sell the carbon credits. And the same is with the risk. So on the one, you have normal business risk plus climate risk, if fire and others. On the carbon credit side, you have in addition regulatory risk. You have the reputational risk, the uncertainties. So for us, that has worked well in the past to differentiate it that way.
Okay. And what about you, Peter? Sorry.
Yeah, we actually also have 2 columns or buckets, but somewhat different in that we are looking at more towards the upstream and downstream. So it's more the nature of the type of businesses that we use. So what I mean by that is we've got the timber plantation, let's say, type businesses that are focused on growing timber products. And then if we go downstream, then we have the more timber processing companies. And the reason we separate them really is because there is actually different ways in which they operate, and there is some tensions between them. So I think it was mentioned by Alexi on one of the earlier panels this morning, but actually if you're in the pure play timber growing world, actually one of the most important parts of flexing your returns is that ability to defer harvesting or not, or increase your speed of harvesting. And so those type of companies, we're really looking at, well, what's the ability for us to do, in addition to timber growth, to be able to do that and flex market competition and so on. But with the downstream, obviously, then we're more looking at it from the other perspective, saying, well, actually, how many surrounding forest assets are available to us? What's our supply chain risk look like? And what's our capability to secure supply? So, and of course, unfortunately, in emerging markets, often those businesses, which kind of sometimes do naturally have a little bit of tension between them, are not fully present, and so you need to actually get into fully vertically integrated operations, and so that kind of needs to be taken into account as well. But yeah.
And so basically, from what you're saying, the majority of your portfolio is into the forestry and forest management. What about as an asset? What about other assets like agriculture or carbon?
Yeah, well, I would say we also have some agricultural companies involved in fish, chicken, some other agricultural commodities. But on the carbon side, I would say we often see it more as a part of these integrated companies, especially, as I say, with the emerging markets. These vertically integrated companies are what you tend to see. And, you maybe envisage another round of financing is needed for timber processing in the future.
Okay, so it's more, the carbon is more integrated in the forest management.
Exactly.
And you already answered a bit. You want to add anything else? I mean, you said regenerative agriculture and carbon being the main assets.
Maybe indeed to bring a bit more detail, Proparco does have a forestry portfolio, okay, on which we have invested or a debt, actually mostly a debt portfolio. This, what we would be sustainable, coin as sustainable timber plantation or forestry. Now what we are trying to do with the natural capital team is actually to go even beyond that and bring co-benefits together with those projects, or to have those as part of our investment criteria. Co-benefits in terms of biodiversity, co-benefits in terms of indeed carbon capture or sequestration. I think we don't yet think in terms of asset classes. Okay, we are at the beginning of our investment endeavor. I would simply add that looking at this from an asset class perspective is very interesting. It's also very interesting to understand at what stages DFIs or different financial institutions invest, and with what kind of financial products. I would say that Proparco is currently thinking to do a variety of things, one of which would be to invest through funds, so indirectly. Another thing will be for us to continue do what we've been doing, is provide long-term debt financing, but also we'll try to bring value with technical assistance. This is something that have not been mentioned yet, but is also the role of DFIs. And also, since Proparco has now also established a practice in terms of venture capital, I think nature tech actually is also an area where Proparco, in the very short term, will also invest some of its capabilities. So just
you always go ahead and almost answer my next question. So as you have it's perfect. Yeah. So because my next question was specifically on the carbon, assets in quotes. At what stage do you provide finance, and compared to other institutional investors? And in a way, you were saying, that what is interesting, what you were saying is that different types of finance. So if is there, how do you see the difference between what Proparco brings to the table and what other investors do? And here, let's focus, because as you said, investing in carbon is quite different than investing in forest. So let's take the example of a carbon project, right? A project that generates revenues through the sales of the carbon credits. And as you was pointed out, the sales actually come much later than the moment the project starts. So it's quite a challenge, journey for a project to take. So how do you interact with other more commercial investors, and where do you see your role? I mean, I know you're in the process. Oh, you can.
Yeah. Okay. You're looking at me, so
yes.
I assume you're expecting an answer. Happy to do so. I think there is a general expectations from the private sector for the DFIs to take, the earlier risk, the higher risk in projects, and then this does not only apply to natural capital, but in general. I think DFIs have a variety of strategies depending on the sector, on the level of experience, expertise, and individual characteristics. So as for Proparco, What our intention is, and I mentioned that earlier, is that we will probably partner with funds to start with on carbon projects specifically, before we venture into investing directly in the earlier stages in equity ourselves. I think that's because we have seen a number of fund managers coming to us with proposals, and I think we can bring value here by taking that risk, but in a diversified way. We will, in a later stage, also contemplate doing direct investments, but probably not for now. I think what we bring is a variety of products. I mentioned technical assistance and the likes, and the ability also to take venture capital risk. What I would add is that we also bring at times a signal, or we bring a label, okay? DFIs have intrinsically, because we've been active in developing countries and emerging markets for 50 years or plus, we bring value by the quite thorough due diligence process that we undertake on every single investment. And I think by bringing DFI money, sometimes in parallel to private money, or alongside other DFIs, I think we should, and we are very mindful of that we are indicating a signal that we think that this company, this project, abides by the best standards in terms of ESG management and basically risk management. Yeah. So I think that's the way I would answer your question.
Before I come to you, I actually want to suggest something, because as NCS Alliance and Forest Investor Club, we are just working on a piece for investors in natural climate solution carbon credits, where we have a very strong section on due diligence on specifically this asset class. So love to hear your feedback later when I'll send it to you. So on this, still continuing on this question, how do you interact with commercial investors, and where do you see your role? I mean, early, anything else you want to add? For example, you Tobias, on how you see, the connection really, because it's a continuum, right? We talked about the value of debt, which I'm sure all of you are aware of, but just how do you ensure that a project has that continuum finance that needs to get until actually generates or issues the credits down the line? And often this down the line is very down the line.
It's a challenge. I mean, again, if we start, and just in comparison, to mention it, if we see the sustainable solid product kind of business, there you have established businesses, and you can do even leverage, you can give debt or equity, and I think the DFIs have a role of institutionalizing these partners and opening up for other private investors and institutional investors and implementing standards. On the carbon credit side, it's much more, newer in the sense, I mean, it's around for 20 plus years, but on the project side, they're much smaller, they need to scale up much more. You have not as institutionalized project developers, so our typical due diligence requirements are challenging in many regards. So to a certain degree, we might be able to help out with some technical assistance, but often we need to aggregate and diversify, and that means often going through portfolios, going through fund managers really, and asking to implement these standards we need. And so what do we bring to the table? I think the rigor on the due diligence process, the standards from IFC performance standards to others, technical assistance to also help both the fund managers as well as on the project level to implement that. And also, maybe, don't want to sound arrogant, so that's a bit difficult, but in the institutional world, everybody, many in the developing world know our standards, but I think on the carbon credit side, the corporates coming in, they're very good in their business, but they're not very used to private equity investment. And I think that is something we can help with, to apply the same rigor. I mean, we are invested in more than 170 private equity funds in emerging markets, to bring that knowledge, not only from the ESG side, but also from the institutional investor side, and build a bridge there, because you do have the corporate investors, which is great, because nobody else is, hardly anybody else is there, so they're really needed in that space. But I think to really push to the market, we need as well the institutional investors.
Yeah.
And that is something they are missing out. And I think, and because of mentioned in other panels now, reputational topics and others, I think we can help hopefully bring this reputation, or our part as far as we can, to bring some reputation to the market, some selection, some rigor, which hopefully can build a bridge where also institutional investor can walk across and join the market there.
Right. Thank you. Peter?
Yeah, I think much has been said, and I would agree with it all, and it certainly is very challenging. I think one of the key concepts that hasn't perhaps been mentioned is the fact that the DFI financing is supposed to be additional. So it has to operate, our mandate is only in the sphere where the commercial financiers will not go. And I think sometimes that causes us, it's challenging, it's uniquely challenging, and we need to come up with innovative mechanisms, and we need to forge partnerships where we can make that additionality argument. I love coming to these events because the room is absolutely full of TMOs, and it's really interesting chatting to those guys and finding is actually there some overlaps between us, where for them it's the mega high risk end, but for us maybe it's the mega low risk end. But actually, is there something there in the middle ground where we can leverage some kind of additionality and kind of draw them to catalyze additional financing. And yeah, I really see our role as to go the extra mile and not necessarily to chase what's the most attractive thing from an investment perspective, but maybe what's can be made realistically sustainable, which is where maybe the commercial sector wouldn't go. But we can help them to that end.
Catalytic additionality, they're all, I think, very valuable, especially, the TMO sector, I don't know very much. I know more the carbon market, but definitely what is interesting is that the term additionality is a central pillar for high integrity in the carbon market. So I see a lot of, a potential convergence between the financing that has to be additional for a tool that is supposed to be additional in order to be considered high integrity.
Yeah.
Maybe we'll open for a few questions from the audience, and then I'll come back to you with our final questions. I don't know who is holding the mic. Yes. So we have one question here.
Thanks, fascinating panel. Thanks very much for sharing your insights. So the premise is that everything is linked. We have high interdependence. You can't alone have financial sustainability. We need natural capital, social capital, political capital as well to be sustainable. And yet, but we've got to focus on the financial sustainability. So if it is all interlinked, then it's great to look at synergies. How do you trade off? How do you trade off some element of finance versus some element of social development? And is that unit of trade-off an index base, or is it currency value? And that's the question. And does that differ in your mix from the carbon projects, those that are interested in insetting versus those that are interested in offsetting?
I don't mind saying something quick. I think we would try to be guided as much as possible by the existing standards and frameworks. The IFC performance standards were mentioned. We all have very well-known FSC forest certification. We have the ILO labor standards. And in the emerging markets, I think what we're trying to do is evaluate where is this operation right now, and within the scope of the financing agreement that we are making with this company or entity, what's realistic, what can we achieve? And obviously, ultimately, we would love to get everybody fully up to the full international standards, but in some cases, it's not realistic. So we just really want to see what's what's realistic, and that we can move the needle on those issues.
Anybody else, or we ask for?
Maybe briefly, I think, well, at DG we have a double target. We have a net profit target and equally important target for developmental impact. And we measure that by our developmental, well, it's called DERA. It's a measurement tool with more than 40 indicators, which we measure each year per project basis. And these two are equally important in basically saying each year whether we were successful or not. And the framework condition for all of that is that we follow an SBTI pathway of reducing our emissions, our attributable emissions from our investees by 4.2% each year to reach net zero by 2040. So basically the climate is a framework, we need to fulfill it, and we have the social developmental indicators and the profitability or profitable financial sustainability linked there.
Any other question from the audience? Otherwise, we'll continue. Okay, so, well, I think what would be interesting is definitely that concept of additionality means that is something in addition, but what are the signals that you think will be helpful to create the better conditions, more, you know, more conducive conditions for even more successful projects finance, right? So we are talking about policies in the generating countries. We are talking about demand for the products. You can interpret my question both into the forestry or carbon. I think we all come with different perspectives depending on what is our walk of life in a way. But I think what would be interesting is to understand that you do not operate, you know, in a vacuum. But how do you see the external forces influencing where your funding go, and what could be good signals that will help you do even better, spend even better your money? Let's start. Proparco.
Proparco. I think it's, yeah, indeed, it's very important that not to operate in a vacuum, and while we set, we have mandates and long-term strategic plans. I think thinking about what the signals could be that would make our life easier, actually, and enable even to do even more in the coming year. I think most probably it's on the integrity front, on the common work of practice and standards that I'm speaking from the carbon finance perspective. Okay, so basically everything that's being done under the VCMI, under on those fronts, okay, to make sure that we have quality carbon standards and in the end products will help us do even more. Otherwise, I do think it's going to be linked to have continue to see the same kind of demand and solicitations, depths of potential opportunities. This will help us in the future. So we see a lot of enthusiasm. It's important for us to continue to assess the depths of the market.
Thank you. Peter?
Yeah, I mean, I think you alluded to it, but the way we would see it is very much about regulation. And there's real power, I would say, in regulation to drive especially use of timber. I mean, I think it was discussed in the panel this morning about the externalities of using steel and concrete still in buildings, when we have this fantastic opportunity to use much more wood. And then the opportunity for that, if those type of regulations and rules can be put in place, that can feed into the opportunities for the timber processing sector, and it all flows upstream, and it all flows into demand for land to be planted, and then again that supports reforestation activities and social development in rural areas. And if these things can happen in emerging markets, all the better. I was at a conference in Kenya last year where the government had announced at the same time as the conference that they had a tree planting target to take the country up to a 30% tree cover, which was fantastic, but they hadn't really put a huge amount behind how they were going to get there. And actually, when I was there, I asked the question, say, what should this be part of a raft of measures, regulatory measures to increase the pull factor, the demand pull factors, because then the market can naturally take charge of the process. And I think we've got fantastic opportunities in timber, in emerging, well, globally for that matter, and especially on the carbon side, to improve carbon pricing, and thus drive reforestation activity.
Yeah, we don't have time to talk about carbon pricing, but that's a very important bit to you.
I think it's just a combination of the two, no? Integrity of the market, regulation in different fronts. I mean, basically in both, in order to create a deeper market with a strong demand signal and pricing, and to integrate more players into the market, which would really crowd in asset managers and others and the big money in order to make it a successful story.
Yeah, you added the demand signal. So basically we have integrity standards are commonly accepted, regulations, demand signal, very important factors. We have one additional question.
Yes,
Not
from the
from
online audience.
Yeah.
So it's been asked, how difficult is it to balance the development mandate and the financial sustainability return requirements in the DFI context?
Ooh, that's a
A juicy one.
I don't mind saying something, because I think actually it goes back to the previous question, which was slightly sidestepped part of it, in that there was a trade-off. I think
yes,
you didn't quite reference.
existential question.
Yeah,
Definitely.
but I do think this is a terrible challenge, especially for smaller companies, because one of our requirements, I mean, talking about practicalities now, very common requirements for us are that, let's say, companies who are not operating to international standards need to hire an environmental and social manager, a senior person with international experience. And in some of these emerging markets, this type of a person is a very big investment.
Yeah.
And if it's a small company, this is essentially adding overhead costs. And then this speaks to the financial sustainability. Is this still a going concern? So this is a barrier, especially for the smaller companies. But I think once they get into that more moderate size, then they just simply, it's a cost of achieving the finance. So I think I wouldn't look at it as a trade-off, because it only comes as part of the package with the finance. And of course, us bringing the finance also unlocks a whole load of other business opportunities.
Yeah.
So when you look at it in the round, the idea is it's a positive, and it's not really a trade-off technically.
What is interesting is that I think maybe the question was more about your existential, how do you match, but I like the way you answer, because he's actually saying your job is to make this business sustainable, financially sustainable. That's your achievement, right? And the financial sustainability also has to include the sustainability, the capacity to stand about, by the performance standards in terms of social, environmental, and so on. So interesting way, to see how your role is to nourish these businesses that are capable of making, return, but also making sure that their business actually has a positive impact. We have 0 minute left. Just if you could say one sentence of recommendation to an investee. I don't know if there are any here, or someone listening to us, what would you tell them about how to reach out to, not necessarily to you, but to a DFI, in terms of what you expect? What is a good pitch in one sentence? Make it short, make it
In one sentence? Okay, this will be tough. Okay, be a going concern, have a powerful sponsor behind you, or have a really, really clever project design with a lot of milestones that enable us to de-risk the project financially, step by step. And I've run out of a sentence.
No, that's perfect. Jean-Gabriel.
Probably by showcasing their track record, local knowledge and understanding of local contexts, key in our markets.
Yeah.
And don't forget to address and be upfront with ESG risks and how you manage them.
Most is said, so I would only add, use the context here in the room. There are great fund managers out here and others who are certainly welcoming you. And if you have done your homework, you will be hopefully successful in really scaling your business.
All right. Well, thank you very much. A round of applause to our three panelists. I learned a lot, and I hope you too and got inspired by this conversation. It's really a nice continuum. You know, investment is the challenge, but we need these funds to flow to the right projects. So thank you very much, and over to the next.